In a 2013 letter to shareholders, Warren Buffett explained, "The goal of the non-professional should not be to pick winners, but should rather be to own a cross-section of businesses that in aggregate are bound to do well." How many stocks should you own to strike the perfect balance between risk and reward? While diversification is a pillar of prudent investing, finding the sweet spot between diversification and concentration is a topic of debate. Legendary investors like Warren Buffett and Charlie Munger advocate for a concentrated portfolio of high-conviction bets, while modern portfolio theory suggests that owning a diverse array of assets helps manage risk and achieve optimal returns. So, how can you determine the right number of stocks for your portfolio? In this video, we will examine the diversification dilemma and discuss the pros and cons of both concentrated and diversified portfolios. We will also explore the factors influencing the optimal number of stocks to own, helping you find the right balance for your unique circumstances and investment goals. First, the diversification dilemma. Don't put all your eggs in one basket is a simple yet essential concept in investing. Nobel Prize laureate Harry Markowitz calls diversification the only free lunch in investing. Diversification helps manage risk by spreading investments across various assets, sectors, and geographies. You might be familiar with the concept of a single point of failure originating from engineering. If a component fails, the entire system collapses. Diversification serves as a safeguard against single points of failure. That's why most retirement plans are allocated to a wide range of low-cost ETFs or mutual funds. The goal is for your nest egg to stay in the game under all circumstances. However, the optimal level of diversification is often a subject of debate among investors. While greater diversification can reduce risk, it can also diminish the chance of outperforming the index, also known as alpha. When it comes to diversification and risk management in terms of investing in equities, involves several risks such as market risk, sector risk, and company risk. So the question is not about how to avoid these risks, but how to manage them. And the best tool to do this is position sizing. Diversification is rooted in the principle that the performance of various assets is not perfectly correlated, allowing investors to reduce the overall risk associated with their portfolio. Of course, there are some pitfalls on over-diversification, which occurs when an investor holds too many assets, diluting the potential impact of individual winners on overall returns. This can result in a portfolio that closely resembles the broader market, making it difficult to outperform. Peter Lynch explained once on One Up on Wall Street, "There's no use diversifying into unknown companies just for the sake of diversity. A foolish diversity is the hobgoblin of small investors." It's a loser's game to buy stocks only for the sake of diversification. Additionally, managing a large number of investments can be time-consuming and may lead to a lack of focus. On the other hand, under-diversification exposes an investor to a greater risk of permanent loss of capital if one or more assets underperform significantly. In his book Principles, Ray Dalio explains that all you need to monitor your downside risk is 15 uncorrelated assets. That simple chart struck me with the same force I imagine Einstein must have felt when he discovered E=mc². I saw that with 15 to 20 good, uncorrelated return streams, I could dramatically reduce my risks without reducing my expected returns. It was so simple, but it would be such a breakthrough if the theory worked as well in practice as it did on paper. I called it the holy grail of investing because it showed the path to making a fortune. This was another key moment in our education. Limitations of the efficient frontier. The efficient frontier is a concept from modern portfolio theory that represents the highest expected return for a given level of volatility, or the lowest volatility for a given expected return. It can help investors construct a portfolio by guiding them to select a mix of assets that offer the best possible returns for their preferred level of risk, ultimately aiming to optimize their investment performance. However, the efficient frontier has its limitations. It relies on historical data and assumptions, which may not be accurate predictors of future performance. It assumes that asset returns follow a normal distribution, which is not always true in real-world markets. It overlooks the unique circumstances, preferences, and goals of individual investors. It uses standard deviation, portfolio volatility, as a measure of portfolio risk. However, for many investors, the risk that genuinely matters is the permanent loss of capital. Although volatility can be unsettling, it doesn't necessarily equate to a permanent loss. Understanding this distinction is crucial when considering the role of diversification in managing risk and the limitations of relying solely on the efficient frontier. In short, asterisk volatility and risk are not the same thing. Second, there are other factors to consider. Concentration builds wealth. Diversification preserves it. The ideal number of stocks in a portfolio varies among investors, as personal preferences, risk tolerance, and investment goals heavily influence it. In this section, we will explore some key factors contributing to determining the optimal number of stocks for your investment strategy. Starting off with risk profile. Each investor has unique personal circumstances which play a significant role in determining the number of stocks they should own. There are 3 types of risks to consider to evaluate your risk profile. Risk appetite, goals. Your willingness to accept fluctuations in the value of your investments for the potential of higher returns. Risk tolerance, temperament. The degree of uncertainty or loss you can handle, which may depend on your financial situation and emotional resilience. Risk capacity, circumstances. Your ability to absorb losses without jeopardizing your long-term goals or financial stability. These 3 factors play a critical role in determining the ideal level of diversification for your unique circumstances. If your primary goal is capital preservation, implying a lower risk appetite, you may lean towards greater diversification. Of course, the answer may be different if you are in your 20s and investing money you can afford to lose. Those with a higher risk tolerance may prefer a more concentrated approach, focusing on a smaller number of high-growth or high-risk investments. If you need the money to put your kids in university in the next 3 years, investing in equities may be a terrible idea, regardless of the number of stocks in the portfolio. After establishing your risk profile, you need to evaluate your time horizon. The length of your investment horizon is another critical factor in determining the number of stocks in your portfolio. Long-term investors can generally afford to take on more risk and may opt for a more concentrated approach, given that they have more time to recover from potential losses. On the other hand, short-term investors might prioritize diversification to minimize the risk of sudden downturns affecting their overall portfolio value. Thirdly, market knowledge and expertise. Your market knowledge and expertise can also influence the optimal number of stocks to own. Investors with a deep understanding of specific industries or sectors may feel more comfortable concentrating their investments in those areas, leveraging their expertise to identify high-potential stocks. Knowing what you own can help you withstand inevitable downturns and stay the course. Those with less market knowledge or who lack the time and resources to research individual investments thoroughly may prefer a more diversified approach, spreading their investments across various sectors and asset classes. As best put by Buffett during the 1996 annual meeting at Berkshire, "You know, we think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks, probably, because there aren't that many wonderful businesses that are understandable to a single human being, in all likelihood." Lastly, 1. Portfolio management style, active versus passive. Active investors, who frequently monitor and adjust their holdings based on market conditions and individual stock performance, may choose to concentrate their investments in a smaller number of stocks to capitalize on their in-depth research and market insights. Passive investors, who take a more hands-off approach to portfolio management, might lean towards greater diversification to minimize the impact of unforeseen events on their investments. Now, for what all of you want to know, how to know how many stocks I should own in my portfolio. How do we strike the right balance? While a rational approach to investing might involve making decisions based purely on mathematical optimization, a reasonable approach acknowledges that emotions, personal preferences, and biases play a significant role in financial decisions. When finding the right balance between diversification and concentration, it's essential to recognize the difference between these 2 concepts. Strive for a reasonable balance that considers your circumstances, goals, and temperament, rather than solely focusing on a rational, mathematical solution. The best method we've found is the analysis of Black Star funds done by Meb Faber when they looked at 8,000 stocks over 23 years. In short, out of every 10 stocks over 20 years, 2 stocks are going to return 300% or better. 2 stocks are going to be wiped out, essentially going down 75% or more, and the remaining 6 will basically cancel each other out. So what do we make of this? For one thing, it does show how heavy concentration can be foolish. With less than 20% of stocks driving most of the market's performance, trying to find winners can be a hazardous hobby. Now, if you only invest in 10 stocks, assuming average luck, your performance depends on the outsized returns of only 2 positions. But more importantly, these 2 outperformers will likely represent more than half of your portfolio allocation if you give them enough time. Would you be comfortable with that? The bottom line is that we have explored the complexities of determining the ideal number of stocks to hold in an investment portfolio. Striking a balance between diversification and concentration is crucial for managing risk and maximizing returns. All in all, some key takeaways are the following. There is no universal answer to the question of how many stocks to own. Instead, the optimal number of stocks depends on personal risk profile, time horizon, market knowledge, and portfolio management style. Diversification helps protect against downside risk, but over-diversification can dilute returns and result in mediocrity. Concentration can boost returns and focus, but may expose investors to increased risk and potential losses without a proper selection process. The right portfolio is the one you can make a lifelong commitment to. As you reflect on this video, take the time to evaluate your investment portfolio. Assess whether your current holdings strike the